CGDV crushed FNDX with 96% returns versus 63%. That 33-point gap reveals which dividend strategy actually delivers growth and protection. CGDV crushed it with a 96% return over 3 years. That's the kind of performance that redefines dividend investing entirely. But here's where it gets interesting. FNDX's 63% return over 3 years sounds decent until you realize how far it's trailing. That gap tells you everything. In plain English, think of it like race cars on the same track. CGDV crossed the finish line 50% faster than FNDX over 3 years. That's not just winning, that's dominating the race. But FNDX flips the script over 5 years with a solid 102% return. Patience really does pay off here. CGDV's 90% return sounds impressive, but here's the catch. This is just the 5-year window showing their best side. Let's break this down further. CGDV crushed it with a 26% return last year. This fund's owning the momentum right now, leaving competitors behind. FNDX's 18% gain looks solid until you realize the gap with competitors widened dramatically, falling behind when it counts most. In plain English, think of it like a marathon runner pacing through the race. FNDX has the better overall finish time, but CGDV's been picking up speed lately and outpacing it on recent stretches. Let's dig into the details. CGDV's Sharpe ratio of 1.5 means you're getting solid returns without taking on excessive risk. That's efficient investing right there. Here's where things get revealing. FNDX hit a 1.0 Sharpe ratio. You matched the risk but didn't match the reward. That's inefficiency right there. Now let's put this in perspective. CGDV's Sortino ratio of 2.0 means it's delivering solid returns while protecting you from those painful drops that really hurt. In plain English, the Sortino ratio is like watching a tightrope walker. You only care about dangerous wobbles, not safe sways. CGDV wobbles less when it matters, meaning fewer scary downside moves for your portfolio. Here's the thing though. FNDX's Sortino ratio of 1.4 signals weaker downside protection. You're getting similar returns but with more painful drops when markets fall. Let's take a closer look. CGDV crushed it with 5% alpha over 3 years. That's pure skill beyond what the market alone would have delivered. Now here's where it gets tricky. FNDX's negative alpha means it underperformed expectations. You took on market risk but didn't get rewarded for it over 3 years. In plain English, alpha is your report card for fund management skill. CGDV earned extra credit by outperforming expectations, while FNDX actually lost points, meaning it underperformed despite having every advantage. Let's see how this plays out. FNDX's 1.6% dividend yield means you're getting regular income deposits while your investment grows, a nice cash flow bonus. Here's what really matters. Where CGDV's yield sits at just 1.3%, the trade-off you're making here is lower income today for potential growth tomorrow. Now let's connect the dots. CGDV's dividend growth absolutely crushed it. 33% over 3 years means your income stream exploded while you held this fund. In plain English, think of dividend growth like leaves sprouting on branches. CGDV grew its dividends 5 times faster than FNDX over 3 years. That's the difference between a flourishing tree and one barely budding. Let's unpack this a bit. All right, time to vote. Who's going to take this? Drop CGDV or FNDX below. Here's the key takeaway. 6% dividend growth over 3 years? That's barely keeping up with inflation. Your income's practically standing still here. Now let's flip the script. A 14% maximum drawdown over 3 years? That's remarkably steady. Most investors would sleep well through that kind of decline. In plain English, maximum drawdown measures how deep your investment can sink during a downturn. Think of it as diving into a swimming pool. CGDV drops you 14 feet, while FNDX takes you down 16 feet. Let's get into the weeds here. FNDX's 16% drawdown shows slightly more downside risk than CGDV, 2 percentage points deeper when markets turn rough. But here's where it gets interesting. CGDV bounced back from its worst drop in just 41 days. That's quick healing that keeps your money growing. But here's where it gets interesting. FNDX took 84 days to bounce back from its worst drop. That's nearly 3 months of watching and waiting nervously. In plain English, here's the seesaw analogy. When markets crash, CGDV pops right back up while FNDX stays down longer. It's about who recovers faster when both get hit. CGDV's worst year saw just a 2.9% drop. Impressive capital protection when markets turn ugly. That's serious downside defense. Here's where the story takes a turn. FNDX's worst year hit -7%, more than twice CGDV's maximum loss. That's a significantly rougher ride downward. In plain English, when the storm hits both funds, CGDV weathers it with just a small leak, while FNDX loses shingles. It's the difference between a minor inconvenience and serious damage to your portfolio. But what about CGDVs putting 28% into tech, which explains why you're seeing that explosive growth and dividend acceleration we've been tracking? Now for the real question. FNDX sits at just 18% tech exposure, 10 percentage points lighter than the market, missing out on the sector driving growth. Let's dig into the details. FNDX tilts heavily toward financials at 16%, classic dividend payers that offer steady income but won't deliver explosive growth. In plain English, CGDV feasted on tech. Those pizza slices doubled in size and paid off big. FNDX? It filled up on financials that just sat there, flat and uninspiring. Sector allocation matters. Now let's put this in perspective. Here's what we've uncovered. CGDV dominated 3-year returns with 96% gains, FNDX won the 5-year race at 102%, and CGDV's 33% dividend growth shows its real power during market recoveries. But wait, there's more to this story. CGDV keeps just 6% in financials. They're avoiding slower growth sectors and betting bigger on faster movers instead. Here's the thing though. CGDV keeps things mostly domestic, but adds a modest 7% international allocation for some global diversification without going overboard. Let's take a closer look. FNDX keeps just 0.06% internationally. It's basically an all-American portfolio with zero geographic diversification, concentrating all your risk in one market. In plain English, here's the egg basket analogy in action. CGDV spreads some investments internationally for diversification, while FNDX stays purely domestic. It's the classic don't put all your eggs in one basket debate. But that's not the whole picture. CGDV's massive 28% tech allocation directly fueled that stellar 96% 3-year return. Sector positioning was the secret sauce here. Let's see how this plays out. FNDX's heavy 16% tilt toward financials contributed to its 63% 3-year return, though traditional sectors typically lag growth stocks. Here's what really matters. CGDV's 28% tech weighting drives that impressive 33% dividend growth. Tech firms boost payouts faster than traditional banks ever could. In plain English, here's your comparison. CGDVs powered by high-octane tech fuel, while FNDX runs on steady financial-grade gasoline. Different engines, different performance. You'll feel it when markets shift gears. But hold on a second. FNDX's heavy financials weighting dragged dividend growth down to just 6%. Traditional sectors don't grow their payouts much. Let's unpack this a bit. FNDX keeps more of your money working for you at just 0.25% annually. That's a serious advantage over decades. Here's the key takeaway. CGDV's 0.33% expense ratio runs 8 basis points higher than FNDX. That's a small premium you're paying for this fund's approach. In plain English, think of expense ratios like couch change you're losing each year. FNDX drops a quarter per $100, while CGDV loses a quarter plus a nickel. Small difference, but it adds up. But there's a catch. CGDV's 5% alpha over 3 years absolutely crushes the tiny 0.08% fee difference. Performance wins over pennies every time. Let's zoom in on this. FNDX saved you 0.08% annually, but CGDV crushed it with 33 percentage points more return over 3 years. Fees don't matter when performance does. CGDV's 1.5 Sharpe ratio shows it's delivering stronger risk-adjusted returns than FNDX, even with that 0.33% expense ratio eating into gains. In plain English, think of fee differences like planning your road trip. Sure, one route costs 8 cents more in gas, but you're getting home an hour faster. Sometimes paying a bit more delivers real value. Let's zoom in on this. FNDX offers a solid 1.6% yield with just a 16% max drawdown. Perfect if you're prioritizing steady income over aggressive growth. Here's where the story takes a turn. CGDV's 33% dividend growth paired with a strong 1.5 Sharpe ratio makes it compelling for growth-focused investors. Here's where the story takes a turn. CGDV's crushing it with momentum. 26% in 1 year, 96% over 3. The trend's clearly in CGDV's favor right now. In plain English, here's the timeline difference in marathon runner terms. FNDX has been jogging at a steady, reliable pace for 5 years, while CGDV's sprinting hard, but only in recent years. Let's break this down further. FNDX's 102% 5-year gain beats CGDV's 90%, a 12-point edge that really adds up over time for patient investors. Now for the real question, CGDV crushes it on risk-adjusted returns. 1.5 Sharpe in 2.0 Sortino means you're getting paid better for every risk you take. Let's dig into the details. CGDV recovered in just 41 days while FNDX took 84. That's half the time watching your portfolio bleed red. In plain English, CGDV dominates this matchup like a victory domination streak, winning recent returns, risk efficiency, dividend growth, and recovery speed. FNDX only takes 5-year history and current yield. Clear winner here. Now let's put this in perspective. CGDV wins the battle with superior risk-adjusted returns and explosive dividend growth, unless you're hunting for maximum income right now. So, which fund fits you? CGDVs for growth seekers, FNDX for income lovers. Your timeline and risk tolerance make the call here. In plain English, think of it like choosing dance partners. CGDV's your match if you want dividends that grow over time, while FNDX suits you better if you need bigger income checks right now. Let's take a closer look. This disclaimer protects both of us. Always do your own research before investing. That said, that's a wrap on our ETF analysis. Hit subscribe for weekly fund battles packed with data-driven investment comparisons you can actually use.